It's a view from the floor here at the New York Stock Exchange, and I'm joined by a very special guest. We have Shannon Saccocia at Neuberger Berman. She is the Chief Investment Officer of Wealth. It's so good to have you. Let's talk about the new year. What do you see as the growth outlook for 2026?
Well, we're very constructive on 2026 from a growth perspective. We have lower interest rates, we have improving economic momentum, and there really feels like some of the enthusiasm that we expected to come into 2025 with, but was disrupted by tariffs. We feel like that momentum is back in place. And so that's not just here in the US, we're seeing global growth reaccelerating, we're seeing continued accommodation from a monetary and fiscal policy perspective. So all of these things seem to point towards stronger growth than we had in the first half of 2025, and a continuation of some of the strong growth numbers, at least that we've seen in the US over the last few months.
What do you think is going to drive equity market performance for this new year?
I think what's really critical and what we're watching most closely is that if you look at 23, 24, and the first half of 2025, there was a significant concentration in performance that was attributed to kind of those large cap tech stocks here in the US, those hyperscalers. A lot of that was based on not only AI enthusiasm, but CapEx that those companies were clearly putting into the ground. I think what we're looking for this year is that we're looking for this broadening out, but it's not just broadening out in terms of earnings growth. We've started to see that underneath the surface, not only in non-tech sectors of the large cap space, but also small and mid cap space. What we're really looking for is those non-technology companies in areas like industrials, financials, healthcare, not just talking about AI, but committing to that CapEx and being able to start to benefit, if you will, from the enhanced productivity that AI is looking to bring. The other thing we're really looking for is that companies are going to need to grow their earnings based not just on productivity enhancement, but growth enhancement, like complementing their strategy. And so really looking at this year as being the year where the rubber really is going to meet the road in terms of AI investment outside of technology, communication services, and utilities.
What are your thoughts on the state of fixed income right now?
It's interesting. I think coming into 2025, everyone was concerned about fiscal sustainability. Everyone was concerned about rising term premium. We look at the long end of the curve, not just here in the United States, but outside of the United States too, and we think that there's going to be some lower volatility in that space, and so not a lot of change in term premium. The other thing is a lot of U.S. investors tend to be in U.S. fixed income and looking just at treasuries or maybe some corporates on the, and for us, looking outside of the United States, looking at JGBs, looking at gilts, looking at bunds. That's an opportunity we think this year to not only diversify geographically, but pick up some nice yield as well.
Private markets has certainly gotten a lot of press lately. Where do you see some opportunities?
One of the things that's been so challenging for private markets over the last number of years is that we've had this drought of distributions, and that's been on the back of lower activity. Coming into last year, we thought that there was going to be a significant amount of M&A. We're actually seeing that pick up over the last 3 or 4 months, and I think there's a lot of headline M&A that's happening, but really thinking about it in terms of smaller companies, tuck-in acquisitions, the opportunity for larger companies to take some of these innovative businesses and tuck them into their companies, I think is really important. That cycle of monetizations, realizations, that's going to lead to greater distributions. That's going to allow investors to have the comfort and the capital to be able to put more money back into private markets and more of that kind of vintage year programmatic approach. And so we're excited about the enthusiasm on the M&A side. We think lower rates and some of that economic momentum that I talked about earlier also supports that story. But we think that both on the credit side and on the equity side should be an interesting year for private markets.
Finally, do you think there's anything else that people should look out for? Is there something that, we're sleeping on and that we should really keep our focus?
One of the things we've been spending a lot of time on is commodities. I think historically, if you look at in a disinflationary period, which we do think we're in, we think services inflation is going to continue to come down, and goods inflation, we think that tariff impact is going to be much lower this year than maybe it was anticipated to be in the first half of 2025. Commodities would seem sort of a contrarian play in a disinflationary environment. However, with the need for industrial metals, with what's happening from an energy perspective, with the need for natural gas, for instance, to kind of fuel this AI infrastructure build, we think that commodities could be an interesting complement to a more traditional just equity and fixed income portfolio.
Shannon, thank you so much for your insight.
Thank you for having me.
Of course, and that'll do it for us here at the New York Stock Exchange. I'm Michelle Yu. We'll see you next time here on Asset TV.